Hey, founders, welcome back to another episode of the Gab Lab. This is a show that is designed to bring you financial intelligence that won't only just blow your mind, but it will help you build your bottom line. I'm your show host, Tanya Woods Richardson, and today's episode is being championed by our very good friends at Community Future Saskatchewan, with over 13 offices across the province to help founders not only build their business, but to help them nail their numbers. So today's episode, I'm very excited to be welcoming back Nail the Number Pro, Ron Robichaud. He is the founder of Demystify Your Profits, and he is also a strong advocate for profiting in business, that bottom line profit. Today's episode is all about golden ratios and industry benchmarks and what we need to be aware of with both of those topics as they pertain to helping us build strong, healthy bottom lines. So thanks for watching, everybody. We'll see you in the lab. Oh, Ron, welcome back to the Gab Lab.
It is my pleasure, always my pleasure to be in the Gab Lab.
I'm so happy you're back for this episode. We're our first episode. You actually joined us for our very first episode, which was Rural Resilience for Restaurateurs. And we're back today to talk about golden ratios and industry benchmarks. It's a topic that, believe it or not, a lot of founders are asking questions about. I'm glad that they're asking questions about it. But let's get right to it because we have a lot to cover today. So as always, with every segment, we're going to break it down into three pieces here. Specifically, the first piece, we're going to take a look at the ratios. The second piece, and this is, this is an area that you've really opened my eyes to, and I know you've opened the eyes of many founders, but it's about percentages and turning our dollar values into percentages and how I call it the highways and hazards, everything just becomes crystal clear. So that will be our second section that we'll talk about. And then our third piece is industry benchmarks and comparing ourselves to others. So that's a whole other conversation, but let's start with ratios.
Absolutely.
So if we get into ratios, and this is an area that it brought me a lot of confusion for a long time. I understood the cash flow piece, but the ratio piece, I think it's so important for business owners to understand. One, because lenders are looking at it. It's the first thing they typically go to. But the other piece is that I liken ratios to our personal health. When we're looking to get fit, we measure ourselves, we weigh ourselves, the BMI, we do all of those numbers and we start to assess where we're at. And that's how I look at ratios. So how do you look at ratios, and what do you feel are some of the most important ratios we should be looking at, and then how to crunch those numbers? So that's loaded, but let's start with what are ratios to you and why are they important?
Well, again, ratio is simply providing us sort of like our health card, as you said, to the business. And typically what I've been doing is that I usually go back 5 years and I calculate specific ratios. We'll get to that in a second. So I can see where the trend has been going. Have they been improving or have they been getting worse? But then it allows us to look at, okay, if we've been declining, what can we do to improve those? So that's one thing. If we're improving, then great, we continue on that path. So there are hundreds of ratios that exist. And I always use the Pareto's law, which is the 80-20 rule. So 20% of the ratios will resolve 80% of your business problems. But I've got another ratio, which is called the Ron Robichaud ratio, that if you resolve that one, you'll solve all your problems. You won't have to worry about any of the ratios. So,
you better fill us in.
Okay, so again, if we look at the categories of ratio, and you've got some of them, we spoke about this before. We got the liquidity ratios, which is basically cash flow. Then we have the leverage ratios, which is basically your debt to capital and those type of things. So, how much do you owe and how much do you own? And then you have your efficiency ratios, which would be your accounts receivable turnover, your inventory turnover, your payables turnover. So making sure that you're paying things on time and you're collecting on time. Because if you have a 30-day, let's say, credit policy, and then we do our accounts receivable turnover and it's 45 days, we got a problem. So, so this is why we can use these efficiency ratios. And then you have your equity ratios, which is debt to equity and debt to capital. So those are basically, if we focused on just those, it will resolve 80% of the business problem. So let's not get too technical in them.
Okay.
But let's go back to, did you have a question there?
I did. Thank you for observing that. I'm just curious, where would then our profitability ratios fall into? Is that the equity, or would you consider that the efficiency?
It would be in the, actually, there are the profitability ratios, which is
Okay.
four ratios. There's the
Okay.
net profit, gross profit, return on asset, return on equity. Those are the profitability ratios.
Okay. So just so I'm clear, we've got the liquidity, the leverage, the efficiency, the equity, and sorry, though the equity is the profitability, is what you're saying. Yes. Okay. Great. Okay, I'm with you.
So if we look at, so let's look at the liquidity ratios. So, and I look at three basically. One is the current ratio, which is simply current assets over current liabilities. So to keep it simple is that for every dollar that I owe in current asset, and in current liability, I mean, because if we understand the definition of current liability is anything that we owe in the next 12 months. Okay, so it's accounts payable, it's vacation, HST payable, it's your line of credit, it's your credit cards, it's your current portion of long-term debt. But this is where I find that there's some discrepancies because sometimes on financial statements, they don't have all the proper categories in their current liabilities. So when you're doing the ratio, it's not really going to give you the right number if you don't have the right categories. So in some
Can I just stop there for a moment? Because I think that's so important when you're looking at these balance sheets, and we'll articulate it in the show notes, but everything you just mentioned, that list of what's coming up in the next 12 months should be sitting in current liabilities. Because I think, Ron, that was a golden nugget, is making sure you're taking the right data to actually do the calculation and not just going with what's on that sheet without understanding what's in that balance sheet. So sorry to cut you off there. I thought that
No.
was so important.
So again, the current ratio, that's why it's called current, because it's current assets over current liabilities. So current asset is anything that is cash or can be converted into cash in the next 12 months. And current liabilities is everything we owe in the next 12 months. So it's all that 12-month period. So from a current ratio perspective, if you have a business that actually holds inventory, your minimum ratio that you want is what we call 2-to-1, meaning that for every dollar of current liability that I owe, I want to have at least $2 in current assets to cover it. If you fall below that 2-to-1, you're going to have cash flow problems, guaranteed. Okay, so that, and again, so if we look at current assets, that cash in the bank, accounts receivable, inventory, prepaid expenses, investments, and your capital account. I want to come back to that in a second. So the capital account. So that again, it's all money that's available to you within the next 12 months. And then the current liabilities is going to be, again, your accounts payable, your line of credit, your credit cards, your vacation pay that's due, HST that's due, current portion of long-term debt, anything that is short-term. Even so what I find sometimes when I look at financial statements is that I'll see, shareholders loan in the current liabilities. And then I look at the notes and there's no agreement of repayment of, so I mean, that's a long-term liability, but if you're doing the calculation, it'll just give you the false number. You think that you owe more in current liabilities than you actually do.
And can I ask a question then on the current assets? Because this current ratio, is this also the one that's known as the quick ratio or the acid test?
Two different ones.
Two different ones. Okay, so I'm jumping ahead because my mind was going to inventory.
That's
So
okay. No,
I'll
that's
stop.
good.
Okay. No,
No,
I will
so
ask then, because I think that the acid test is where I was like, okay, I think we take out the inventory out of that one, but that's a separate one. So
yeah. So the current ratio, again, you want 2-to-1 minimum. The higher, the better. Okay, so you're actually looking at 3 or 4, and coming back to those industry benchmarks. I mean, we'll get to that in that third segment, but I think, you should always aim for the 2-to-1 is the minimum. So you should be looking for more than that. So again, coming back to how often should we look at this? Every month.
yeah.
So we should be looking at that ratio every month, because if the ratio is getting worse, then it tells you what should I be doing next month to start to get back on track. Because if I continue on this trend, I'm going to be in real trouble in 8-9 months from
Right.
now.
Well, I think
So,
that's what was so relevant about how you started this conversation off as well, is charting your trajectory, right, from 5 years back, not from today's starting point, but what has the line looked like, right? From, has this been a trend over 5 years, or is this just a small little slump? Although, through COVID, I'm sure a lot of people experienced a drop off the cliff moment there. But thank you for that, to just be aware of what those patterns have looked like so that we can understand, is this just a COVID related incident, or did I go into COVID vulnerable and I need to fix that story? It's not about, oh, we'll just go back to normal, because the normal was not your ratios were not adding up. So thank you, Ron, for that.
So when we look at, so again, coming back to the current ratio, you as an owner of a business, you can also say at the end of the year, I'd like to be at 3-to-1. Okay, so that means that for every dollar of current liability, I'll have at least $3 in current assets to cover it. If you're there, you'll be fine. You're not going to have any cash flow problems. So then we look at the next one, which is the asset test, which you related to, or the current or the quick ratio. And when we call quick ratio, it means quick cash. If I needed money in the next 30 days, can I have access to that money? So normally you have cash in the bank, your accounts receivable, hopefully you'll get paid within the next 30 or 60 days. I mean, so we can, that would be an issue. But the only vulnerability is that it's not guaranteed that we can convert all our inventory into cash in the next 30 days, because normally inventory is for longer periods. So we actually take the current assets minus the inventory, and I actually take away the prepaid expenses, because I'm not going to cash in an insurance that I just paid. So I just take really the quick cash that's available to me within the next 30 days. And then I still owe the current liabilities. That doesn't change. We still owe that money to somebody in the next 12 months. So then we take the current assets minus your inventory, prepaid, stuff that it's not going to be easily accessible to you in the next 30 days or 60 days. Then you divide that by the current ratio, the current liabilities. And there you should have a minimum of 1-to-1.
Okay.
So for every dollar that you owe, you want at least $1 in current assets to cover it, quick assets. And then again, if you're below that 1-to-1, you're going to have a cash flow problem. Okay. So one of the things that some people, this is another quick note that you can use, is that let's say that your current ratio is 2.5-to-1, meaning that for every dollar that you owe in current liabilities, you have $2.50. And then you do your quick ratio, because you've taken away the inventory out of the equation. Now it's 0.85-to-1. So it's below that 1-to-1. The only thing we changed was the inventory. We took the inventory out of the equation. So if our current ratio was fine at 2.5-to-1 for the current ratio, and now the quick ratio, by removing the inventory, we're at 0.85-to-1, that means that we have too much inventory on hand. So you should be selling some of your inventory, convert it into cash, get your ratio back to where it should be.
Wow. Okay. And correct me if I'm wrong, though. With COVID, we might not have just been able to move inventory. People might have just been sitting with it, which might then prompt them to say, okay, maybe we need a different delivery model, right? If people aren't coming in the store, maybe we need to get these products online, do it through e-commerce, whatever that looks like. But what you're suggesting is get that inventory out to make sure that your ratio is sitting back where it needs to be. That 1-to-1 is what I'm hearing.
And be careful how much you're ordering. Because, you've got a lot of salespeople right now that are they're in the same boat. So they say, do I have a deal for you? If you buy this stuff, if you buy this quantity, I can give you 15% discount. Well, then if you have to use a line of credit in order to support the financing of that inventory, which is going to now last you a year and a half because you have to buy this large quantity, it's a trap. You're going to get into a cash flow problem. So I would always look, you don't want to run out of inventory, but just buy the inventory that you need, but price it properly. And so that, don't compromise those sort of. Yeah.
Beautiful. I will just comment here. We had a pro in here that was speaking all about retail and inventory. And one of the comments that he made, and we'll put it in the show notes, is exactly what you're saying, or to that effect, where everybody needs to take on a portion of the risk now. the suppliers and the buyers. It's not one person wins out of all of this. Everyone's got to meet at the table and find a way through it, right? Although we can see the light at the end of the tunnel, thankfully. But so I love that comment. I think that's really important for a lot of founders to hear about, don't jump all in and jump on the discounts. Make sure you've got a way to move that to keep that ratio in check. Okay, so those are the liquidity ratios, which speak to kind of our short-term position. And then we get into leverage ratio. So I'm hearing the two that we have there. What do we need to look for when we start talking about leverage? And what does that mean exactly?
Well, leverage would be the ratios that we see in leverage. Hold on now. I just want to make sure that the main leverage ratios are where are they now? Because there's a few here. They're basically the profitability. Those are the profitability ratios. The leverage ratios is return to asset and return to equity. And so the thing is that the amount of assets that you have, you want to make sure that they're making you money. So when we talk about leverages, you're leveraging your assets in order to gain some profitability from that. So is every piece of asset actually working to make you money? So you can do it on an individual asset basis, or you can do it on the total asset basis. And so the other thing that you want to look at too on the leverage side is that for every dollar of asset, how much do you owe? Because you can only financing a business, leveraging a business, or financing a business is only two ways. You can either finance it through assets, or you can finance it through equity, meaning that you put your money in. So if you're financing it through assets, you want to make sure that, and again, typically it doesn't matter what the industry indicators are. I always look like a 50-to-1 ratio, meaning that for every dollar of liability, that I have at least $2 in assets. Okay. So if I take the total, when I talk about leveraging, because if you need to go to the bank, they're always going to look at, is there any equity left in borrowing or lending money?
Right.
So leveraging some of that money, you can use some of that equity that you have in the business. But if your debt to equity, or your debt to capital, I mean, is 1-to-1, meaning that for every dollar that you owe, you only have $1 of asset. You know as well as I do that any financial institution on commercial buildings, they only lend out 65% of market value, 50% of equipment value, 20% of inventory. So you got to have a whole lot of assets and that market value in order to be able to do that. So coming back to the leverage ratios, I'm always looking at what do you have in order to leverage some of that financing. So again, the amount of assets that you have and the amount of liability that you have, you want at least a 2-to-1. So basically, again, for every dollar that you owe, you have $2 in. And that would mean, because if you look at a balance sheet, you take all your assets,
Right.
is equal to your liabilities plus your equity. So if your liabilities to capital, or to the liabilities, or capital to liabilities, or debt to equity ratio, or debt to capital, I should say, I'm getting confused here, but debt to capital, and probably confusing your audience too, is that for every dollar of liability, I have at least $2 in asset, which would mean that you also have, for every dollar of asset, you have 50 cents in equity, or because the 2-to-1 it has to add up to 1. Your
Okay.
assets equal liabilities and equity.
So if I step back for a moment, I'm going to put myself in the shoes of a startup here. So a startup borrows $100,000, takes that $100,000, most likely is investing $75,000 of it in some sort of capital expenditure, equipment, or inventory. So, and then maybe $25,000 in working capital. So in the beginning of starting up a business, we're not going to see that 2-to-1 ratio, because they're highly leveraged, right? They're at the point of getting started. And as they progress now through the building of their business, and this is where the work that you do is so powerful, because the idea is about building profitability into your operations, because then that profitability comes in and it goes into retained earnings, which starts to increase the value of the business, which is where we start to build that ratio up. We start to strengthen that ratio, increasing that value. So as I'm wrapping my head around this, we have two ways to increase value. We have the profits of those quarterly or annually returns. They go into retained earnings, and or any sort of capital investments that we've made, I guess specifically into property. I'm trying to think of capital investments that increase in value versus depreciate in value. Property is one of those that would start to bring up the value, or the ratios start to strengthen that ratio, where some of the equipment, not so much inventory because you're turning it over, but some of that equipment is going to depreciate in value. I love this. This is all starting to make sense to me. It's like a little bit of a teeter totter where you really do have to start to understand that we're looking to build up our asset side of the business through that net profit, through the value in the expenditures that we invest in, or if we're investing in depreciating assets, making sure they're making the money for us in the window of that opportunity to increase that value. Okay, you're blowing my mind there. I'm getting it, Ron.
Okay, so on that point, let's talk about EBITDA, earnings before interest, taxes, depreciation, and amortization. So what I've seen is that, and again, it's not necessarily the true picture of a balance sheet. So an example of that is, let's say that somebody, and I just had a client here a couple of weeks ago, he bought a brand new truck for his construction business, paid $84,000 for that truck. Okay, so now his accountant, and he asked his accountant, like, I just bought this truck, so in his year end was coming up, so yeah, we're going to depreciate it by 30% because that's what CRA allows us to do that. So now I said, did you finance your truck? Yeah, I got a great deal, 0% interest on 84 months. So now he's financing it for 84 months, which is 7 years, and the accountant is depreciating at 30%. So in 3 years' time, 90% of it will be depreciated. So in 3 years' time, he's got 10% left on the value of the truck and he still owes 4 years. He's going to be in trouble when we look at those ratios.
Makes sense.
And that is happening in 98% of the business, of the financial statements that I see. So we have, because you're going to be looking at your ratios, the value of your asset on your balance sheet compared to what you owe. And so this is where the discrepancy comes in. So what I always, again, the ratio that I look for in that debt to capital ratio is always try to get to that 2 to 1 or 50 to 1 or 0.5 to 1, meaning that for every dollar of liability, we actually have $2 in assets to cover it. So if you monitor your balance sheet, then you're going to start to see how come my assets are going down so quickly and my liability is not going down as quickly as my depreciation. And that's a problem.
And that's why. Okay.
So one more thing on that point, though, is that if you're going to do any expenditures on any asset that you have, whether it's a building or a piece of equipment or whatever you have, if it's going to increase the value of that asset, capitalize it, meaning that you're going to go to the balance sheet. Let's say you just spent $50,000 on the roof. So then go to your building and add the value of your building by $50,000 on your balance sheet. Don't expense it as repair and maintenance, because again, this is where people get in trouble. So when you're doing that, is that you're simply increasing your operating expenses in order to reduce your net profit. Yes, you're going to pay a few less pennies in tax. I should say pennies or dollars.
Yeah, okay, yeah.
But your balance sheet's going to suffer because it's really being depleted and it's not the true market value of your business. So the two questions that I ask entrepreneurs is that if it's going to increase the value of your asset, excuse me, capitalize it. If it's not going to increase the value of your asset, expense it as a repair and maintenance.
So important, Ron. Thank you for sharing that, because I know many founders, when they're looking for money, that's when they go to the bank. That's typically when the bank is saying your ratios aren't adding up. They're not having the conversation with the accountant, because you're right. It's usually this short-term gain of I'm going to pay less tax in that year, but the long-term consequences of that decision are going to impact the value of the business. This kind of reminds me of a rich dad, poor dad conversation, where focus on building value, focus on building assets, focus on building investment, right? Versus doing what you can.
The disconnect a little bit is that 30 years ago, it was still 30% for vehicles. But 30 years ago, and so CRA has not changed their depreciation rates in 30 years. But if you look 30 years ago, when you bought a vehicle, you could not get a loan for more than 3 years for a vehicle. Now you can get a loan for 96 months, which is 8 years. So your depreciation table should never be shorter than the amount of the length of financing that you're doing for any asset.
Wow. Okay. All right.
Does that
Thank
make
you.
sense?
We've done some deep diving there. So we've talked about the liquidity, the two there. We've talked about the leverage one here. You had mentioned something that I want to just talk about here. I think it's important. We talked a little bit about pulling dividends from a business when you're in a deficit position. That was for me, that was a moment, one of those founder bombs that I think everybody needs to hear about. So can you elaborate on that a little bit?
Sure. So when your business is in a negative equity position, and not by necessarily your own doing, but it comes back to, again, the way you're depreciating things and everything else. So all of a sudden you have less assets than what you owe because you took you're depreciating stuff in 3 years and you borrowed it for 8 years. So yeah, your ratio is going to start to go wonky, but your equity position is going to go into a negative situation where now you owe more than what you own in assets. So whenever the equity or the shareholders' equity is in a negative position, and people have been accustomed to taking dividends out of their business, it's illegal to take dividends when you're in a negative equity position because you're actually stealing from your company. And CRA will red flag that. And I see it time and time again on financial statements. So,
Wow.
I wonder about this.
I know. I'm just going to be silent there for a moment because I need all the founders to really let that sit in. One question on that, is that for a specific period of time? Because here's my worry for many founders hearing this. Many founders aren't looking at their statements until 4 months after year end. I have no idea what position they're in. So is this for the given year? So if at the end of the year they're in a negative position, but they took dividends in that same year, is that when the flag happens, or does it happen quarterly? How does that work? And that might be a loaded question.
It's at year end when you file your financial statements with CRA. If you're in a negative equity position and you have taken any dividends,
Okay.
you are in.
Okay, I really hope founders are hearing that right now, because if that was ever a reason to go speak to your accountant before, I know we're right now, as this episode is airing, we're heading into the year end for many business owners, or we're at the start of a new fiscal for some. But this is where, again, don't leave your reviews until 4 months after year end. Get on top of this.
Because look at it from this perspective. A limited company is an entity in its own. Okay. So now dividends can only be taken out it's after you have net profits, and dividends are taken out after net profits. You have to have net profits in order to take dividends. So if you're in a negative equity position, you probably have losses. So now you have losses, and you're still taking money out of the business.
Yes.
You're actually, because you as a shareholder, you are simply a shareholder of that entity. So you are actually stealing from that. Theoretically, that's what it would be.
Okay. Well, I think it's important for people to know this was a crazy year. 2020 was crazy. 2021, where, it seems like things are slowly turning right side up, but definitely make sure that you're speaking with your accountant. Better yet, understand the numbers, be able to pull the reports yourself, see what position you're in, and then ask your accountant the questions, right?
Absolutely.
To protect
Conversation.
Okay. So Ron, with respect to ratios, we've talked about the three there with respect to the leverage, the two in liquidity. Are there any others that you think are really important for founders to stay on top of to really effectively manage their business?
Profitability ratios.
Okay.
Net profit and gross profit. And so, listen, and you should be looking at this on a monthly basis. But the problem is, and it comes back to the way that you're doing your accounting, because I'm always, you have to have the right information in front of you in order to make informed decision as a business owner. So when a lot of things are just waiting till the end of the year and let the accountant do all the year-end adjustments, you're not dealing with the right information. So it comes back to, net profits. My game is that any business, doesn't matter what sector you're in, doesn't matter what volume of sales you are, doesn't matter where you're located geographically, you should be aiming for 10% net profit. So when I talk to a lot of people, I said, if nothing else, focus on that. And what strategies can you put in place in order to inch up to that 10%? Because I can tell you now, if you get to that 10%, all of these ratios will be fine. They will be. You don't have to worry about any. Your cash flow will be fine. Your all your equity ratios will be fine, and all your leverage ratios will be fine. But coming back to that is that this is where, again, coming back to depreciation, which is what we call a non-cash outlay expense.
Mhm.
Although you have a loan that you're paying, and the principal on the loan is basically your amortization, is that if you wait till the end of the year, you're gonna know you may get a big surprise, because if you think you're doing well all year long, and all of a sudden you do those adjusting entries, which some of them are like $100,000 in depreciation, all of a sudden you were at 4% net profits, now you're at negative 2% net profit. Well, how can that be? All year long, I really struggled and made sure that I was getting net profit. So I always tell people, learn how to do a journal entry on a monthly basis on your depreciation, because any asset does not depreciate once a year. It depreciates all year long. So every
Mhm.
month do that depreciation, which
Mhm.
comes to my point about a capital account. There was in over 1,000 businesses that I've worked with across Canada in the last 10 years, I've only seen one business that actually had a capital account in their current asset. So the capital account is simply this:
You've got it. Yeah.
is that the amount of depreciation that you're taking on a monthly basis, because you've already expensed it on your income statement, take it out of your current account, cash, set up another account, call it a capital account, and put that money into the capital account. Learn to operate on whatever's left in your current account. Then you will have all the money you need to replace your equipment when it breaks down, to repair them and everything else. Because if you have your money in your current account, what's going to happen? You're going to spend it.
I love that. Okay, let's let that sink in. I'm going to a cash flow statement right away, but I think that's important. I think there's a lot of parallels with a personal budget as well, right? And let's plan for a holiday and, take that money out, put it aside, right? So this is what I'm hearing when it comes to depreciation or amortization, taking that money out. The other reason why I think that's so important, Ron, is that oftentimes it's hard for founders to wrap their head around the authenticity of or the actuality of their true cash position because of the amortization and depreciation. They're like, "Oh, there's too many numbers that aren't really what's in my bank account." So I think this is where they get confused about the reality of what the value of their business is worth and then this confusion around what's in their bank account. So taking that money out, I love this, set up a capital account, take out that depreciation, put it in there. Two questions on that, and I know I'm muddying the waters here, so I apologize. Is that capital account where you would also recommend they start taking their taxes and putting those aside too?
Well, again, it depends on the type of corporation that you have,
Okay,
because
okay,
according to CRA, if you're up to a certain level of taxation, you need to do installments on a monthly basis.
okay.
So I would encourage people to do those installments. That way, you're not going to get that big bill at the end of the year. But on the other hand as well, is that yes, you can use that capital account in order. Again, it's still your money. It
Yeah,
doesn't really change anything, but I call it my
yes.
rainy day fund. I can always
Brilliant.
access that money if I'm short. So it comes back to that more or less cash flow
Yep.
assistance. So it's really, that helps a lot. So coming back to the profitability ratios, and again, you were saying on the personal side or on the business side, and it's sort of a revelation here. I was just talking to a lot of people that are working in the agricultural sector, and I said, one of the conversations you have to have with every entrepreneur is, first of all, is decide what do they need to live on, because the business has to support their life, their well-being on the personal side. But I said whatever they need, so calculate everything: food, if they're paying rent or have a house or a mortgage or whatever, car payments or whatever, birthdays, Christmas gifts, whatever, like put everything down. If you're not sure, get yourself a little scribbler and write down everything you spend money on. I go to Tim Hortons twice a day, put that down. So how much money do you need to live off? And then I say add 20%, because that 20% is your retirement. You need to put some money aside. So whatever it costs you, add 20%. So that's the amount of money that the business needs to generate. So when we look at that, the business also has to generate a minimum of 10% net profit after you've paid a reasonable salary to the owner in order for them to be able to live. So when you look at those two equations, it starts to make a lot of sense to a lot of people.
Yes.
Oh, okay, that's why I'm having so much trouble.
Yes. So let's just repeat that for everyone listening, because I think that is that's key to making this work. Because a lot of business owners at the end of the year will say, "Oh, you know what? I'm so excited! I generated a 3 to 4% net profit." Yes, they deserve to celebrate. They're not break even. They're not deficit. But the first thing that we look at is, was there a fair owner salary in there? Fair market salary. That's the first thing any evaluator is going to put in, right? It is usually not there. People are scraping by and, just taking what the business can afford them when it can afford that. So what I'm hearing you say is understand your personal budget, understand what this business needs to pay you, probably weigh it with what is a fair market salary, put that in there, make sure you're planning for that. And then in addition to that salary, this is where we're still looking for a 10% net profit. Okay. Can I ask, where did 10% come from? Why 10?
Because, okay, so with all, if I come back to Stats Canada years ago, every 2 years, all the businesses, whether they're sole proprietorship or they're incorporated, they all have to fulfill the requirements and submit their financial statements to CRA. So CRA, in conjunction with Industry Canada and Stats Canada, they've come up with these worst in sector performers, average in sector performers, and best in sector performers. So what I've noticed is that all the best in sector performers, which is the 25 percentile, top 25 percentile, are all making more or less 10% or more net profits. That's why they're successful. So this is where I say 10%, but some businesses, especially in sort of like the healthcare sector, whether it's massage therapists or kinesiologists or chiropractors, or they're all in the 25 to 30% net profit actually.
Wow. I think that's going to blow some minds of founders listening in, because of the founders that I have worked with that are in that space. They struggle with this, especially those independent founders they're really just trading time for money, and then they reach out, they reach their capacity, and then they get stuck. So we'll get into that in a little bit, but thank you for really kind of laying that down for everybody, that we're looking for that 10% net profit. So thank you for this segment, Ron. There's so much in there. I do want to come back to when we started this part one about ratios. You talked about the Ron Robichaud ratio. And my guess is, I am going to make an assumption here, that is the profitability ratio, correct? Okay.
If nothing else, even when I talk to like economic development officers or whatever, challenge your clients, challenge entrepreneurs. If nothing else, how are you going to get to your 10% net profit? Because we all have limited resources of time and money.
Yeah.
So I would like, if nothing else, just focus on that. How are we going to get to our 10% net profit? If you do that, you're going to have a lot of success.
Beautiful.
If you just focus on that one.
Beautiful. And you know what I will mention here, because this comes up quite frequently, and I saw the threads of conversation through COVID, where there's this stigma in society that profiting is bad, right? That businesses thrive at the cost of people, at the cost of purpose, at the cost of planet, for the sake of profit. And I think it has come at a huge disadvantage and a huge cost to small business owners, because now there's this resistance to profit. Profit is the health of the business. And Ron, as you just pointed out, we need that profit to go back into retained earnings to increase the value of the business. And just so everybody can wrap their head around this, the value of the business means we get to stay around. We get to employ more people. Our GDP comes up. I see small business owners really as the road to recovery for this economic, I don't want to say disaster. I want to be mindful of my language, but we are in hot water as a country with respect to the deficit that we're at. Sorry, Ron, you want to?
No, this is a really good point and a good segment is that, and in the previous segment that I did, I think I mentioned this, is that, and I know with COVID, the government has spent a lot of money in order to, subsidize, in order to maintain cash flows and everything else. That I understand. But just prior to COVID, and this, we haven't had, the COVID is only in the last year, okay? So prior to COVID, we still know that 50% of all businesses never make it to the fifth year, okay? And that's been a tradition for the last 35 years since I've been keeping track of these statistics. I didn't go back that far. I still know that 80% of all businesses that surpass 5 years make less than 1% net profit. So, and I'm a strong proponent, take care of the pennies, the dollars will take care of themselves. If we are able to increase the net profits of our 80% of those businesses that are only making 1%, I'm not even talking about the 50% that are no longer there, because they're not contributing at all to government income, because they're losing money and they're not paying any corporate taxes or income tax. So, but those 80% that are making 1%, if we were able to increase those 80% from 1% to 4%, which I can do overnight, we would eliminate the Canadian debt in 4 years and not increase any taxes. How much better off would we be? So this is why 1 to 4%. I mean, if let's say somebody is charging, I don't know, $250 for a product or whatever. So if I take $250 and let's say I'm only making 1% net profit, and the only thing I'm going to do is I'm going to increase my price by 3%. So I'm going to increase my price by 3%. Whoops, I got to put the calculator on. So multiply 1.03. So now I'm going to sell it, my $250 item, I'm going to sell it now for $250.50. I have just quadrupled my net profits because I went from 1% to 4%. And that's $7.50 more on a $250 item.
Wow. I love watching you work. It all makes sense when you do it. It seems so simple. And I think this is the thing. It is simple. It is simple for founders to do. I think that perhaps they're just starting from a disadvantage where they don't really understand their numbers, feels very gray to them. They don't know how to actually start implementing these changes and the impact that it would have. So thank you for the work that you do and the clarity that you bring to founders, especially around that net profit. Because the other piece here that really landed with me as you were talking is that if you have net profit, all the ratios take care of themselves. Don't start trying to fix the ratios, just fix the net profit. Everything, the dominoes just start to, I don't want to say they start to fall because that sounds negative, but they get you to the end line, right? In this beautiful formation. So
let me give you a very quick example on that, just so that we pretty well clear the sort of segment. So let's say you have a business that's selling for $250,000. Those are the gross sales, okay? And let's say the owner invested $50,000 of their own money in order to start this business. And let's say that it's like 80% of all businesses, they're making 1% net profit. So 1% net profit on $250,000 is $2,500. Your return on investment, okay, which is one of the ratios, is $2,500 divided by the $50,000 that you invested initially, which is a 5% return. Now, let's say that we're able to get to our 10% net profit. So our no more sales, the same sales, $250,000. Now we are achieving 10% net profit. Now we made $25,000 in net profit as opposed to $2,500. Our return on asset is now 50%. We went from 5% to 50% just by getting to our 10% net profit. That's why I say all the ratios will clear themselves if we do that.
Brilliant, brilliant. What a great way to leave this. Just that example for people to really bite into. Okay, thank you, Ron. As always, there was tons of clarity in there. So thank you for that. So appreciate your time. We're going to see you back in here for part 2. As we close off part 1, I just want to thank our episode champs, Community Futures Saskatchewan. They have over 13 offices across the province to help founders figure this stuff out. In addition to Ron coming here to kind of lay the framework. So make sure you visit your team there, Community Futures, one of the offices across the province. Ron, thank you for being here. We're going to see you for part 2, where we're going to talk a little bit about percentages and how that will help you to better understand, gain clarity around where you are right now and where some of the gaps might be and how you can fix those. So thank you for your time. We'll see you back in here for part 2.